Paul always suspected King Crab was more of a title than a name. And he wants to be the first human to bend the claw. Because one day, the crustaceans will rise, and only Paul will be spared. Foresight's a wonderful thing. Invest in innovation, including 3D printing, with Opto.
I want to set the scene, I suppose, and talk about the kind of political context, the macroeconomic context of which markets are operating in. There's been a lot of talk, understandably, about Trump and Biden, even over here in the UK. I'm interested to understand, though, the likelihood of tech stocks either outperforming or underperforming under those two differing administrations. Should we be more bullish on tech stocks under Biden or Trump, and vice versa?
So to be clear, when you look historically at the S&P 500, you go back to 1957, the average annualized returns for the S&P are actually higher under a Democrat president as opposed to Republican. So generally, if you have a Republican in office, you still have positive returns, but it's not as strong historically as when you have a Democrat in office, which seems a little bit counter to logic, right? Because one of the main arguments for Republicans is lower taxes, right? And yet the markets tend to actually do relatively worse. Now, when you dig down a little bit deeper, what you find historically is that from a sector standpoint, generally, when you have a Democrat in office, technology does really well. And that's actually consistent with congressional trades, meaning, those in Congress that are Democrats tend to trade and play with the tech sector more. Those who are Republicans tend to focus more on the energy and kind of real world sectors of the broader market. Now, this is interesting, right? Because let's play it out. Let's say Trump does win, as so far the public suggests is indeed the case. You're already starting to see the broader market maybe start to respond on what that might mean for tech stocks. NVIDIA is getting a lot of attention, right, more recently because of some comments around, maybe the U.S. should not be intervening if China were to go into Taiwan, which has all kinds of implications on the chip sector. But I think broadly speaking, if Trump is going to ride the wave of economic populism, that means you need to have a spreading out of economic prosperity, which means you have to somehow, on a relative basis, hurt the tech sector.
Yeah.
Right. So it seems plausible to me that a Trump presidency would result in tech being a laggard. It doesn't mean it has to go down. It just means that it's not going to be the only place to be like it has been the last 4 years.
Yeah, got it. To, I guess, exacerbate that trend then, I think it was in a recent article, again, I read potentially on your Substack, you spoke about a potential Trump administration targeting tech companies under antitrust laws, other regulatory measures. Firstly, how likely do you think that is?
In general, unlikely, but it's not low. It's not super low probability, right? I mean, it's just, as we know, there's all kinds of issues with trying to enforce some of these laws, especially when tech companies are in so many verticals, right? To begin with, but the threat of it might be enough to cause some investor nervousness.
Yeah. Okay. And to your earlier point, then, if that were to happen, that just exacerbates the story of investors having to look elsewhere outside of the tech sector for outperformance.
Right. Now, admittedly, that's a kind of a hard thing because from a fundamental perspective, it's true. The earnings have been in the tech sector. Right. So if you're going to try and do a rotation out of tech into something else, hopefully that something else actually has growing earnings, right? And actually has decent fundamentals. Otherwise, if it's purely sort of I'm afraid of tech, so I'll go into something else which is not tech, if it would work for a moment in time, but it's not it's likely not a long-lasting situation.
Yeah, okay, got it. And looking beyond the election cycle, how do you see the tech sector evolving under either a Biden or Trump administration in the longer term? Are there specific kind of policy directions that could significantly alter the trajectory of the tech sector performance, do you think?
Yeah, look, I mean, everything goes back to competition and using, in quotes, national security as your way of protecting, competition. Yeah, I think any sort of policies that impact anything when it comes to the only tech that matters now, which is, the semiconductor, NVIDIA, AI side of things, it's got to be policies that impact China and impact competition in terms of a copycat, right, to those types of products, which I know is very hard to do, but that's That I think is sort of the most important dynamic. I mean, if you have a headwind against that, that will have implications on margins, margin pressure, and resulting in lower earnings. That in turn results in disappointment. Every single, I don't care if it's Trump or Biden, both of them will view the semiconductor industry as crucial to national security.
Yeah.
That doesn't mean that you're not going to have competition anyway, right? And
Mhm.
policies that may inadvertently cause that competition to come in place.
Yeah, I think got it. Yeah, I want to come back to semis and NVIDIA in particular, but before I do, again, I read another one of your articles. I think it was on Substack, but may have been picked up by CNN or CNBC. And you described the June CPI report and how that indicates cooling consumer inflation, ushering in kind of a swift market rotation that we're seeing now, small caps overtaking the mega cap growth as the market leader. And historically, sharp moves like this have coincided with market bottoms. Not always, but on average. So should we see this as a significant bullish signal in your opinion?
Yeah, so this is where it's conflicting, right? Because to your point, as reference, it's not always, right? But at major market bottoms, that's when you tend to see that kind of sharpness in small caps versus large caps. By the same token, generally when you're at the start of a cutting cycle, the market starts coming down, right?
Yeah.
And you end up having the bottom is still yet to come. So there's a conflicting message there as far as sort of what the movement tells you. I do think this smells to me like it's some major hedge fund or institutional player that's blowing up. And I know that sounds dramatic, but you think about what is it that very large institutional players do? They're trying to get non-market-like returns that are alternative in nature, non-correlated. They have certain unique strategies, quant models. One of those might be a model that says you, the manager, should be in your portfolio shorting small caps and going long large cap tech because the relative strength is all there. So why take the beta risk of the broader market? Why be 100% long only? Why not short a part of the market which is not doing well, small caps, and maybe even dollar for dollar, go into large caps, right? So you're neutralizing the beta. But importantly, you're then leveraging into that to magnify that spread differential expanding. So when you have these multi-standard deviation shocks in spreads like we have seen the last several days in small caps versus large caps, the implication there is that somebody's off sides, right? There's a panic covering on the short side of that spread trade at the same time as there's a panic selling on the long side of the large cap tech play because it's basically the exact opposite of the trade which works so well that was levered into. So a lot of people see the move and they say, well, this is what you see, right? This is what you see at the start of a major rotation. I'm not disagreeing that there's a longer term case for small caps outperforming large caps because it is so beyond stretched. There is a cycle, and there's a real argument to be made that small caps should lead. The question is the speed of this move. Is it really indicative of anything? Was the disinflation news the spark for a bigger trend, or was it the spark for offside spread trading margin call dynamics which are taking place? I think it's more the latter, but we'll see.
Yeah. Okay, great. Now, to dig into that point, what specific kind of metrics or indicators are you following just so that for us, I guess, kind of keen to follow this trend and follow the narrative, what can we look out for?
So I'll relate that to a question somebody asked me on X, said, what's the next major thing to focus on outside of small caps? I said bonds, right? And utilities as the bond-like sector of the stock market,
right,
is part of that.
Yeah.
And this even relates to the question of whether it's a bottom because of the small cap, large cap movement, or the bottom is yet to come because the Fed cut cycle is coming. The answer to that depends entirely on credit spreads. Right. So if we're in this immaculate disinflation, if the Fed pulled it off really well, then yield should drop as we're seeing at the periphery, and credit spread should stay tight. The differential between junk and AAA, right, should stay tight.
Yeah.
If the disinflation trend accelerates, but at the same time as it accelerates, you start seeing a wider differential between junk debt and AAA. That's more consistent with what you see in a recession and bigger drawdown for equities. Right? So watching the bond market will be your ultimate tell on what happens next. Either way, it does seem like we're past this nasty cycle of the last 3 years. Like we're now in a new environment.
Yeah.
Right? New environment, not in terms of AI, in terms of the direction of monetary policy. And if that's the case, it could be better, it could be worse, but it's definitely going to be different. And either way, there should be some newer opportunities to play with.
Yeah. Okay, great. Yeah, I want to come back to that AI point, but before we do, you mentioned the Fed there. I'm just interested to get your initial take on Trump's comments yesterday that seemed to suggest he'll essentially reverse his position and actually back Jerome Powell to complete his term at the Fed.
Yeah, why not? I mean, it's like, the market loves, in quotes, stability. Right? It's like the devil you know is better than the devil you don't.
Yeah.
I mean, I think what matters more from a market perspective is Trump's view on the cryptocurrency standpoint, industry, right, in general, more than Powell. Look, I know there's a lot of focus on Powell as like the guy that runs the real president, the guy who's really behind everything.
Yeah.
The reality is he doesn't know what's going to happen next either. I don't care how confident he appears.
Yeah.
If I'm Trump and I'm an asset owner, I probably wouldn't mind having at the head of the Federal Reserve somebody else who also is ultra high net worth. Powell's worth something like 40, 50 million, which probably means Powell does not want to see the stock market go down either.
Yeah. Yeah, interesting. And let me just come back to that AI point then, because I don't want to forget that. And we've kind of discussed at least parts of the bull case for small caps in the short term, but how about the bear case for large caps? Your recent article mentioned that AI mania in the US might end the dominance of US large cap stocks. Can you just explain how you see that playing out?
Yeah, I've had that thesis actually really since last year. I was very early in saying it, but I said early last year as NVIDIA hype was taking place, I think we'll look back on this AI mania that's back then, I could see starting to form, as the blow off top for US large cap dominance. Right? And I still maintain that view very much so. People forget that large cap the U.S. has been outperforming since 2011. It's been outperforming small caps. It's been outperforming international developed really since 2008. So you're talking about a really long cycle, right, where it's been a game of just tech momentum, tech fundamentals. But that relative ratio at some point gets so stretched and you need some narrative to really get it to the extreme. And I think AI happens to be that narrative. Right? So the implication there is what? Everybody goes into the same trade. NVIDIA's in every single portfolio. It doesn't matter if you're bearish on NVIDIA, because if you're bearish on NVIDIA and you have the S&P 500, you can't be bearish on NVIDIA because you've got a big portion of your portfolio through the S&P in NVIDIA. So, but when everybody's in the same position, knowingly or unknowingly, simply because of how large the position is in most portfolios, that overcrowdedness tends to mark a blow off top. Right, and that is clearly the story of what's going on with AI. I think it's a good thing, right? I mean, I say that purposely because from an industry perspective, these environments are horrendous. I don't care if you're running a mutual fund, if you're running an ETF, you're running separately managed accounts, doing asset allocation. You can't beat the S&P 500 when it's the only game in town. What has made the S&P 500 the only game in town? Large cap, U.S. tech, international, not so much. Obviously not bonds, right? Small caps, definitely not. So I'm a little biased. Like, I'd love to see tech no longer be the standout because it becomes a lot easier to stand out when it's not tech.
Yeah. Yeah, well, that's a perfect segue then to talk about other options, I suppose, for in kind of the pursuit of outperformance when you're a long-only equity investor looking to beat the S&P 500. We've talked about small caps, but let's turn our mind to international developed and emerging markets. In light of their underperformance relative to US markets, which you've already mentioned over the past decade, slightly more than that, why could now be the time for an international tilt, and what key tailwinds could drive a resurgence in those markets?
So I think it's a sequence question because I think there's still a risk of a super spike in the dollar. Just a very sudden move, right? Which is like if you have a real crisis with my reverse carry trade thesis, right? Initially the dollar moves higher, and then after that comes the liquefying and then dollar weakness. But it is about the dollar, right? I mean, generally speaking, weaker dollar is better for international, stronger dollar. So I go back to that point about U.S. large cap dominance. When QE3 and Operation Twist from 2011, 2012, right, was taking place, I remember very well back then, everybody said, all of this monetary stimulus is going to create hyperinflation. Back then in 2011, 2012, that's why everybody was so hyped on gold, which was the top for gold, right, roughly back then. it went the exact other way. The dollar actually started rallying from a secular low, right, around the time everybody thought hyperinflation was coming, right? So here we are with the dollar where it is. You need to have the dollar weaken in a meaningful way for there to be finally a tailwind for international. But that also relates to the point about large cap tech. Because large cap tech is largely just US only phenomenon for the most part in terms of public markets. So I'd argue that you need to have large cap tech weaken for the dollar to weaken. Because as long as large cap tech is the only place to be, you're going to have foreign money that's going to the US dollar, bidding that currency up.
Yeah. Okay. Got it. I think, well, what will be most useful for me and hopefully the listeners would be to then focus in on a specific part of that kind of other option, which is international, which is obviously a huge kind of area of the market. If we focus in on China, for example, I think, again, another article that I read, you described it as having economically bottomed, which could prove a potential inflection point. What evidence supports that view, and how should investors approach kind of China-centric companies and funds despite that recent underperformance, which we've already discussed?
Yeah, and it's important to keep a note. I mean, keep in mind, China has underperformed for a long time, not just in terms of their stock market, but obviously economically. And unless you believe the cycle is dead, at some point, time takes care of time, right? You'll see a turn up. First of all, they are, from the PBOC perspective, they are taking actions that will allow them to have more flexibility to inject liquidity. So they're paving the way for policy response, which I think, at the margin should help juice economic growth and activity. I think even though copper has pulled back, I think the strength in copper confirms that, right? There's a feeling that there should be an acceleration relatively soon. Now I'm not talking about like a super cycle where China just rockets higher, but you're probably closer to, at the margin, at least a little bit of a turn, and all you need is a little bit of a turn for there to be some optimism of China growth, maybe countering U.S. economic weakness that could be coming. I will tell you unequivocally, it is very true that relative to the size of the country, it's probably the most under-owned part of the world. Yeah. Relative to the size of in a portfolio versus, right? It's because a lot of people have just been nervous about investing in China. A lot of financial advisors don't want to allocate to China. They don't even have funds in their portfolios that have the word China in it. So because of bad press and all kinds of justifiable things that get people concerned. When I see that, and then I see the markets looking like they have bottomed, and I see economic news still kind of weak, but maybe improving, I say to myself, okay, if you're going to be contrarian, I'm not saying to buy and hold it, right? But if you're going to be contrarian, I think there's a price for China, sure. Right? I think that because it's so underinvested on a relative basis compared to so many other parts of the world, there could be some outsized returns there. A lot of people like to talk about Alibaba as an example. Yeah, that could be a big winner, sure.
Yeah, interesting. I mean, I hadn't planned to ask it, but almost when I speak about China or hear from experts on China, you end up then discussing India because as a kind of US-based investor, your decision to allocate internationally often boils down to, at least for that part of your portfolio, China or India. The people I've spoken to, the decision more often than not has been to India, more recently. How do you see that kind of dichotomy playing out?
Yeah, I mean, India's been on fire, right, as we know, and has been a clear beneficiary relative to scared money in China has basically gone into largely India, just because of friendshoring, you can call us, right? I still would probably rather choose China over India just on a relative basis, right? It's like India's done very well. It's not a new story. China, in a different place. It's worth noting that I think when people think about investing in India, they are thinking in terms of the country is being driven by technology and infrastructure spend and all that, being the real driver. A lot of the India-based, broad-based ETFs, the largest sector in those ETFs is financials by like a mile.
Right.
And if you look across the board, and when you look at India funds, their financial sector, their banks make up around a third on average of a lot of the, which is just something to keep in mind because banks are not supposed to be the high flyers.
No.
Right. I mean, and yet that's what's been driving it, right? That's why. So you may want to get more granular at my point rather than into the broad-based funds. But India is a great long-term story, but like everything else, it's probably stretched.
Yeah. Yeah, completely take your point on the financials as well. Yeah, that's really interesting. And I think at this point then I want to move, I've referenced probably about 5 or 6 different articles I read prior to this call, a lot of which were available on Substack. So I'm interested to dig into the lead lag report at this stage and just understand what you're doing there and what's different about it versus other investment publications. I read I think it was in the About section, you emphasize a long-term data-driven approach to investing. Perhaps you could just explain firstly, though, how your award-winning market research has influenced the strategies you present in that report.
So look, I come from a naturally skeptical place when it comes to pretty much everything. Right? And I'm a portfolio manager myself of strategies which have not done that well because of the cycle around treasuries where they have to be risk off in treasuries. Okay, never mind that. My skepticism comes from the fact that you have a lot of people and a lot of traders that claim to absolutely crush it in the stock market. But when you actually look at the data, we know that most people underperform the S&P 500 if they're trading only stocks, right? Stock picking, other than NVIDIA, stock picking really doesn't work, right? And you can backtest it and prove that. And it's easy to say NVIDIA with hindsight, but for the most part, it's very, very difficult. So I say that because because I come from a place of skepticism, I backtest a lot of different strategies. And I believe I know what works and what doesn't over a very long-term time frame.
Yeah.
Right. And that's the sort of key thing, over a very long-term time frame. My core belief is that nobody can the best you can do when it comes to markets is identify the conditions under which volatility is likely to change.
Yeah.
Because if volatility changes, you can switch your long-only mix into things which are either less volatile or could benefit from volatility for a moment in time. So it's whereas a lot of people tend to think about trend, for me, it's much more about volatility dynamics. So from that standpoint, the research looks at risk-on, risk-off signals, different ways of expressing those signals, high-yield ideas, macro observations, sector momentum as it's starting to turn, highlighting things which show relative momentum before it gets too entrenched. I'm fortunate. I've got a lot of subscribers who are much more on the institutional side that appreciate the work, that recognize, like every other publication, I'm going to be wrong and right. One thing I am not is one thing I'm not going to do is tell you, here's something that's at 10x your return, because that you should be skeptical about.
Yeah, absolutely. And there's plenty of that around. Your report, I guess, as you mentioned there, aims to help investors capitalize on, well, I've called them here market trends, but actually it's the risk on, risk off dynamics and how to exploit those. I guess essential to any successful investing is often trying to recognize these things before they are widely recognized by everyone else. So perhaps you could share an example of something of that nature that you've identified earlier and how your subscribers or anyone else reading your report were able to benefit from it.
There's something you said that's interesting there, which is that it has to not be widely available, because the argument there is if it's widely available, it's already, it's arbitraged away, whatever the anomaly is. So my only counter to that is true, but if you're in an environment where those indicators are not working and people start doubting the indicators are about to work again. Right?
Got it.
Because it's like you have to have doubt for any anomaly to persist, and doubt happens when you're at the extreme of everybody believing the indicator works. So the indicators might be out there and then doesn't work for a long time. Then because people think it doesn't work, suddenly it now matters. From my perspective, the different indicators are known for: utilities against the market, lumber relative to gold, long duration treasuries against intermediate. You can argue they have not mattered the last 3 years. There's a nuance there because it's more about the expression of treasuries as the way of going risk off, as opposed to what they tell you about from a volatility standpoint.
Right.
But if you're in a low vol environment, volatility indicators don't matter because you're going to get whipsawed in that broader type of low vol. If you believe volatility is likely to rise on a sustained basis going forward, the indicators will likely not get whipsawed as much. You're not going to have as many false signals, in which case utilities, when they outperform, will be a risk-off signal. Be careful about volatility. Lumber to gold being weak, like it has been for some time, another risk-off signal. But the point is, one, you have to have doubt around the indicator's effectiveness. That doubt happens to occur during cycles where you're whipsawed a lot. And then at some point, the cycle takes care of itself, and then suddenly the pendulum swings back towards the anomaly.
Got it. And to finish that, I mean, throughout that explanation of your approach and the philosophy almost that you operate by, risk management is obviously a key component of that, and therefore the lead lag report. In an era of high volatility, what specific risk on, risk off indicators do you focus on, and how can investors use those indicators to actually protect their portfolios?
the best indicators are price themselves,
Yeah.
right? It's not economic data, which is really what intermarket analysis is about, right? Sort of try to see the message of the markets from a relative strength perspective beneath the surface and figure out is there a shift that's happening.
Uh-huh.
Of all the things I focus on, the utility sector has the most history. It goes back to 1926, whereby if the utility sector is outperforming, up more, down less. So the broader stock market, that tends to precede higher volatility, again, on average, right? More often than not. So I think that's why even, before our conversation, I said, I went from small caps hold the key to utilities hold the key. Because as we've seen the surge in small caps, utilities are actually holding in and now outperforming pretty sizably, which is more consistent with a risk-off type of signal, and why I'm also hesitant of the small cap move sticking short term. The lumber to gold signal, I think, will matter more as housing becomes less distorted. So lumber is a tell on housing through construction. Lumber has been very weak, and housing has been disconnected from a lot of things because of a lot of issues. The lock-in effect around mortgages, the tight inventory, all this stuff. But to the extent that those dynamics are fading, I think the message of lumber relative to gold probably becomes more powerful or more likely to not get whipsawed. And then the real big signal is going to be treasuries themselves. I mean, we went through this horrendous duration bear market, right? Not a credit spread widening credit bear market. If treasuries start to show some strength when volatility is rising, then you have to return to the flight to safety dynamics. Finally, the phoenix I keep getting wrong on for the last year and a half, and then there will be an opportunity to make some money for a moment in time tactically in the long bond. But signaling wise, I think I'd have more confidence in utilities and lumber to gold now than anything else.
Yeah. Got it. Well, I think that's a really nice insight to end on. That just leaves me to say thank you very much for joining me on the podcast, Michael. It's been a real pleasure.
No, I appreciate it, guys.